Navigating the Investment Climate Ahead of Trump's 2025 Inauguration. Hello everyone, welcome back to the channel. Today, I want to talk about the investment climate as we head into Donald Trump's 2025 inauguration. Whether you're trading daily or steadily building your retirement nest egg, political shifts can have a major impact on where your money might find the best opportunities and the biggest risks. Let's take a closer look. First, to see where we might be going, it's important to reflect on Trump's first term from 2017 to 2021. During that period, we saw corporate taxes cut from 35% to 21%, a concerted push toward deregulation, and, at the same time, heightened trade tensions, especially with China, resulting in tariffs on billions of dollars worth of goods. These policies sparked strong performances in certain sectors, yet introduced fresh volatility. If a second Trump presidency follows a similar playbook, we can anticipate both a boost in the business environment and potential upheaval in the trade arena. Market sentiment in 2025 will hinge on how smoothly Trump's agenda takes shape. On the fiscal side, investors will watch closely for signals of additional corporate tax cuts or renewed discussions of large-scale infrastructure projects. Financial institutions may again see deregulation, potentially improving their profit margins and fueling M&A activity, although more cautious voices might worry about systemic risk. Trade policy will be one of the biggest question marks. The past taught us that tariffs, especially on Chinese imports, can result in unpredictable swings in share prices of companies reliant on global supply chains. Multinational corporations, particularly in the technology and automotive sectors, might respond by further diversifying their manufacturing hubs if they anticipate more tariffs or trade disputes. New or renegotiated trade deals with countries like Canada, Mexico, and European allies could open up new opportunities for exporters, but might also create friction depending on the specifics. Meanwhile, the Federal Reserve operates separately from the White House, but policy decisions out of Washington can still push the Fed's hand. If a second Trump administration enacts stimulative measures like tax cuts or expanded spending, and if supply constraints persist, inflation might accelerate, prompting the Fed to hike interest rates more aggressively. Growth stocks, especially in technology, are highly sensitive to rising rates, so investors should remain vigilant in monitoring these shifts. Different sectors could experience varying outcomes. In energy, traditional oil and gas exploration might get a green light, potentially boosting fossil fuel stocks, while clean energy companies could see fewer direct federal incentives. Defense and aerospace, which have historically benefited from Republican-led administrations, may reap rewards if spending remains robust. Technology is a wild card. While large-cap tech companies flourished during Trump's first term, tensions surrounding social media and regulatory calls to rein in big tech could reemerge, so investors may want to keep an eye on legislative developments. Healthcare could also be a battleground if reforms around pricing or insurance structures come into play again. All of this extends well beyond U.S. borders. Potential trade renegotiations or tariff battles could significantly affect global markets, supply chains, and investor sentiment worldwide. Industries such as automotive, technology, agriculture, and consumer goods often feel the brunt of these policies, so overseas partners and competitors will respond in ways that could ripple through the markets. In light of these uncertainties, it's vital to remain flexible. Diversification remains a key principle for portfolio management. Never put all your eggs in one basket, regardless of how favorable any single sector's outlook might seem. Investors who track both immediate policy changes and enduring macro trends can best position themselves for success. Ultimately, whether you're optimistic or cautious about a second Trump term, preparing for some level of volatility is always wise. The key is staying informed, doing your research, and being ready to adjust your strategy as new information emerges. If you found this discussion helpful, don't forget to like and subscribe for more in-depth looks at how political shifts can affect your investments.